So wait a minute, isn't 11.6%, isn't that what I'm trying to get in my stock portfolio and that has risk? And this cash value, it can't go down, it only goes up. And that's when I knew it clicked. So I'm at dinner with all my closest friends, and the host looks at me and says, whole life insurance is the biggest ripoff in the world. And everyone looks at me because they all know I sell life insurance. And I could just see the anxiety on his wife's face that he shouldn't have said that. But I just smiled and I looked at him and I said, interesting. Biggest ripoff? When's the last time you ever looked at one? And instead of arguing in front of everybody, I remembered something I learned from one of the top advisors in my firm, who also happens to be #1 on Forbes financial security list since forever. And I asked him, can you name me an investment where you make 10 payments, pick the day you die, and you can tell me to the penny after tax exactly how much you get? And the host looks at me and says, well, that doesn't exist. And I smile back, yes, it does. And he leaned back, and to his credit, he was open and fair-minded, and he said, Luke, if you can show me that, I'm going to buy some. So in this video, I'm going to show you the exact thing I showed him, where by the end of the conversation, we both laughed, and he said, well, I guess I'm buying some whole life insurance. Here's how the conversation went. Because once you reach a certain level of financial success, you're going to run into this problem. You have money that's, on one hand, too important to risk, but on the other hand, it feels too stupid to leave it in cash. It's your just-in-case money, your peace of mind money. And he was a successful business owner, so I knew he'd understand that. But that's not where I started. Most advisors will start with spreadsheets and presentations or brochures. I started with one question, and it's a love question. And I said, Jeremy, who are you building this for? And I've noticed something interesting after meeting with a lot of successful people. Most of them are getting hit all the time with email pitches, cold callers, but very rarely are they challenged to think bigger or to think from the heart. Because when you strip away all the spreadsheets, every financial decision really does boil down to one thing. Who are you building this for? And I went on to ask him, hey, Jeremy, if life insurance were free and you didn't have to pay for it, like no strings attached, and without being unrealistic, how much would you want your family to have? If you knew you weren't making it home tomorrow, how much life insurance would you want your family to have? And just instantly, I could tell his wheels are turning. He's thinking about his 5 properties, where my mortgage balance is, what business debt do I have, what's on my balance sheet, what could my wife sell the business for? And I stop, I go, no. That's not what I asked. This isn't a spreadsheet. This is a love question. This is about, you've got one last check you get to leave your family. How much do you want them to have? He gave me a number, and I told him, well, you know what's funny, Jeremy? That number, when we run the math, it's probably going to be exactly what you need. I'm going to tell you now, Jeremy, why people buy whole life insurance, but I'm also going to show you the role that life insurance really should be playing in every financial plan. Because sometimes the life insurance benefit, that's really the secondary or tertiary reason to why we're doing this at all. Most wealthy people have the risky money, real estate, business interests, stocks. They have their liquidity money, checking account, savings account, money markets, whatever. But they don't have a third bucket, safe money, fully protected, that's going to grow into something really big and transfers well to the next generation. Most people's safe money has low returns, but if it had high returns, it's taxed out the wazoo. Whole life insurance is different. It grows 100% tax deferred. You have the ability to pull money out tax-free in the form of loans. And 3, the death benefit is tax-free. So no tax, no tax, no tax. What are the downsides? Well, it's very expensive. Traditionally, it takes 10 to 15 years for the policy to even break even what you've put into it, the value you'd have inside. But from there on, it is such an appreciating asset. But what makes me different is how we design the policy. What we do is we take the most money that the government will allow us and we jam it right up to that limit. And what that does for you as the consumer, it takes that main downside of life insurance and just squashes it down. So all of a sudden, your plan isn't as expensive as the fully commissioned product or the fully margined product. You're taking advantage of the insurance company, that the company you're paying less, Luke Tomlinson you're paying less, and mortality you're paying less. And what you're doing is you're setting up a space for your cash to grow tax-free. But will it outinvest a really good market-based strategy or be better than what your stockbroker is doing for you if he's taking care of you really well? Well, if it doesn't, you need to fire that guy, because this is just another space for your cash to grow in the safest, purest investment you'll ever have. And if you die, your stockbroker, he's not going to go, well, Jeremy, I've got an extra $5 million for you. They aren't doing that, but I am. I'm bringing millions extra to the table when your family needs it the most. And when I said that, Jeremy sort of stepped back and said, Luke, can you say that again? And I said, look, at the end of the day, everyone dies. But when hundreds of people show up to honor you or someone you care about, I'm going to be sitting there too. And I'm going to be the only one with a check in my pocket. And I understand no one wants to talk about life insurance, but can we agree that if we knew you weren't going to make it home tomorrow, we're glad we're having this conversation? Now, earlier I said that this isn't a spreadsheet question, and I meant that because the decision about protecting your family and providing for your family, that's a love question. That starts in the heart. But eventually, we do have to look at the numbers. So I'm going to show you, here's whole life insurance, given your current age at 39, assuming average health, compared to what you're already doing in your bank accounts. In the first few years, all we're really doing is moving from your left pocket to your right pocket. Your cash isn't gone. Life insurance done this way is not a bill, it's savings. So when you look at this, you can see it's right here. The difference is now it's sitting in a place that's tax deferred and you get a death benefit. Now fast forward about 10 years in that same pool of money, still safe, still liquid. At this point, year 10, you're done paying. No more premiums, no more money going inside. It's basically like a 10-year mortgage that's fully paid off, except unlike the house, no property taxes, and this continuing to grow tax-free. And you may notice there is a funny number to how much money you put inside. It's not a round $1 million, 100,000 times 10. And the reason for that is when we're doing these cash-rich designs, there is a science to it, but really there's an art to it. Like I said before, the IRS only allows so much money to be put inside these policies. And if you want to be able to put more inside, it's super easy. We just have to add more death benefit to it. So if your goal was to put in an even Steven 1 million over 10 years, we could do that. We just probably would increase the benefit from 1.5 to $2 million. And then I showed him 20 years in, and I think this is where it clicked for him. He suddenly realized that his just-in-case money sitting in his checking and savings accounts that he thought couldn't grow transformed into a real asset. Imagine reaching this point and you realize that your worst investment, like your safe money, the lowest risk reward, actually becomes one of the most reliable things in your entire financial program. But let's be really specific for a minute. Let's put numbers to this. Let's look at the growth between year 20 to year 21. You go from 1.6 million, 40,000 bucks, up to, that's $95,000 tax-free growth. Your cash value is now $1,739,000. And Jeremy, that 95,000 of growth, that's a 5.8% return. But because it's tax-free, and it is, if you're in the highest tax bracket, Jeremy, here in California, which I think if you aren't now, you're probably going to be because your business is doing really well, you'd have to get almost 12% return in a taxable account to match this, 11.6% exactly. So this is the ripoff everyone's been telling you about. And I could tell when I said that to him, he was still skeptical and he paused for a long time. He was looking at my numbers and I could tell he was fact checking my math. And I just told him, hey, Jeremy, pull out your phone, pull out your calculator, call your accountant if you need to. Yeah, it's not going to hurt my feelings. So I could tell he was working on things for a few minutes on his phone. Then he looked at me and goes, so wait a minute, isn't 11.6%, isn't that what I'm trying to get in my stock portfolio? And that has risk. And this cash value, it can't go down. It only goes up. And that's when I knew it clicked. And I summarized it back to him. Jeremy, can we agree that when we look at life insurance from a rate of return perspective at your demise, it's the kind of return we hope the market would do for you. But this has guarantees and with no risk. And then I continued on to show him the 40-year graph. And nothing dramatic has happened. Gosh, he hasn't been paying for this for 30 years. He only paid the first 10. But the number gets surprisingly large because this is what safety and consistency creates over decades. And this is where I think it becomes really obvious why wealthy, savvy, smart families have been doing this for generations. So when people say rich people don't buy life insurance, in reality, the only people who could do this type of policy are rich. I mean, who has $100,000 they could just put in for 10 years? That's not most people. If anything, only rich people should be doing life insurance. That would be a way more fair critique. Now, I happen to think it's useful for everyone, not because it's magical. I've just learned that regardless of someone's wealth or income or how old they are, everyone wants at least some level of cash or safety net in their life. And more often than not, they're also going to want money for their kids or grandkids when they're gone. And that's the exact job that whole life insurance accomplishes. So the whole paradigm of you should only buy term insurance when you're young because later on you'll be so rich it doesn't matter anymore. It's such an oversimplification. It's such short-term thinking. And it's the kind of thing that leads people to have dramatically less growth on their safe money. Maybe some people want only 5% of their net worth safe. Maybe you want 50%. It doesn't really matter because we're all different. The key is everyone needs some money that they can rely on. I don't know how much, but some. So if we can agree that everyone needs some level of guaranteed cash, so why not put that inside a life insurance policy where it's going to grow tax deferred? Why should we be forced to solely rely on bank accounts with low returns and taxable interest? If my high yield savings account and my Roth can have a baby, I should want that. If I can get double or triple the returns for no extra effort, no extra risk, no extra fees, I think you should look into it. If you're someone who has money sitting in cash, money that's there for peace of mind, or it's your just in case money you probably aren't going to spend anyways, maybe it deserves a better home. Maybe it should be designed to create wealth and value for your kids and grandkids. So when someone at the dinner table says, whole life insurance is the biggest ripoff of the century, I usually just smile because they're thinking about it as an investment. That's not what it is. And at the end of the day, building a financial plan that's going to last decades and provide for your family, that isn't a spreadsheet question at all. That's a love question. If you're curious to review your life insurance program together, or you've heard that whole life averages 1.2% and it has piddly returns, I'm happy to walk you through some examples. There's a link below if you want to start that conversation. See you in the next video.